Good morning. This is John Richardson speaking with you from Toronto, Canada. Today is Monday morning, January the 27th, 2025. And my return guest this morning for all things dealing with, complex U.S. tax issues is U.S. tax lawyer Virginia La Torre Jeker. And today we are going to be talking about something that is simultaneously new, simultaneously important, and I think it's important that everybody at least understand that this exists, whether you understand it or not. So here we go. Good morning, Virginia.
Hey, John, it's early evening-ish here very soon.
All right. Well, so in 2008, Congress passed the 877A exit tax provisions. I think this was called the HART Act, wasn't it? HEAR.
That's right. Yes, it was.
Nothing more loving than this. Absolutely. It's sort of like getting a Valentine. Maybe they should have passed it February the 14th or something. A Valentine from Congress. So it established the exit tax provisions, which at this point I think most of our listeners are aware of. But it also established something else, which are called the covered gift tax provisions. Now, the exit tax provisions are part of the subtitled A, the income tax provisions of the Internal Revenue Code, but they have a special Valentine for subtitle B, which is basically a transfer tax, a tax paid by the recipient of a gift or a bequest from a covered expatriate, right? So in other words, kind of a bit of another punishment for renunciation. And that's what we're here to talk about today. That is found in section 2801 of the Internal Revenue Code. And I think we're going to begin with a general description of what it says, and then we'll have some discussion about why it's important and a few lessons that you can take from this, even if you don't understand the provisions all that well. So, does that sound like a plan, Virginia?
I think so. I think it's a fair plan, John, because the regulations which were finalized earlier this month are very complicated. They're 129 pages long. You and I have been going through them on our own. We've been liaising about areas of confusion, and we, as very seasoned tax professionals, are struggling with these regulations. So I don't expect the average person, the listener, to absorb everything. So we have to keep it as simple as possible.
I agree. And I would add to that this is not something that I would expect the average tax advisor or tax professional to understand without a considerable investment in time. Would you agree with that?
Absolutely.
So,
absolutely.
I think that part of the problem here is going to be recognizing the issue, but I honestly think a second part of the problem is going to be finding the right kind of person to even advise on this in complicated cases. So, I think that listeners might consider doing everything they can to avoid this problem altogether. But let's begin.
And avoiding the problem means avoiding covered expatriate status.
Absolutely. This is triggered if you expatriate and you're a covered expatriate, whether you're a green card holder or a U.S. citizen. And Virginia, since that's the group this applies to, I think it might be good to start off with a review. What would make somebody a covered expatriate? Maybe you can help us there.
Sure. Okay. Before we get into that, I just want to mention one point that I think is very important. You are correct that these transfer tax regulations under Section 2801 apply to covered gifts or covered bequests, which are gifts or inheritances received from a covered expatriate and received by a U.S. person, a U.S. citizen or a U.S. resident. The problem is going to be, and we're going to get into this later on, I'm sure, the problem is going to be that while that's the rule, someone who gets a gift or bequest from a former American, even if that person was not a covered expatriate, has the burden of proving that this is not a covered gift or bequest. The responsibility falls on them. And that's not going to be easy. How will someone know if grandma or aunt so-and-so or uncle so-and-so or dad was a covered expatriate unless they have discussed this, they have shown tax returns, and they have evidence that the person is not a covered expatriate? This is going to be a very burdensome set of rules, not only for people who get gifts or bequests from covered expats, but from anyone who gets a gift or bequest from a former American.
Right. Whether they know it's a former American or not, right?
Well, here's what I think is going to happen with that. So you get a gift from a foreigner or a bequest from a foreign person. You just know they're not an American. And you have to fill out a Form 3520 Part 4 to say, I have received a gift or an inheritance from a foreign person, and it's valued over 100 grand.
Okay, so let's pause there. Now let's pause there. That's not a new rule. Okay.
No, that's not a new rule.
It's been in effect forever. So I think it's important as a reminder, okay, that U.S. persons who receive gifts from non-U.S. persons in excess of $100,000, this is a bit of an oversimplification, are subject to very stringent reporting rules. This is on Form 3520, I believe.
Correct. Part 4, IV, Part 4.
Penalty on this is also very significant, isn't it, Virginia?
25% of the value of the gift.
Yeah, I would say that's significant.
Oh, yeah.
For the failure to fill out a form that has no tax consequences that you couldn't even know would exist, right? As we've
That's
seen
right.
over time. Okay, so that's an important reminder to start with. So that's the context, right? A gift or bequest.
So the person will fill that out, the Form 3520 Part 4. I believe that form is going to be, in due time, expanded upon by the IRS, and the questions will follow in due time. For example, was the person who gave you the gift or bequest ever a U.S. citizen or ever a green card holder? If so, see Form 708. You may need to pay a transfer tax. There's going to be a link up, is my point.
Absolutely.
To Form 3520, and this, now the regs are finalized. We're still waiting for this Form 708, where people report and pay tax on their covered gifts or bequests. So there will be a linking with those, just the way we've seen with FBAR on the tax return, asking, do you have any foreign financial accounts? If you check yes, maybe you need to fill out FBAR, see this. So there will be a connection. It's not there at the moment, but I believe it will be coming for sure.
Yeah.
And once the IRS gets that information, they can ask, hey, how do you know this person wasn't a covered expat? Prove it to us.
Exactly. And to your point there, Virginia, the recent proposed Treasury regs, one of the proposals was to expand the reporting requirement for foreign gifts from just acknowledge that you got the foreign gift to who specifically did you get it from.
Yes, they want identifying information.
Yeah. So in other words, this is all part of, trying to get more information, et cetera. So where we are in the conversation now would be this, that all gifts over 100,000, okay, received from a non-U.S. person are required to be reported. And now some of those gifts from foreign persons might be from former American citizens or green card holders, right?
That's right.
Okay. And the danger is that if the former citizen or former green card holder is a covered expatriate, then we have the prospect of having to pay the covered gift tax. Agreed?
Yes.
Okay. Can you help us understand what it would take for somebody to be a covered expatriate?
Okay. So A covered expatriate is someone that is a former U.S. citizen, so they gave up their U.S. citizenship, or a former long-term resident. So that would be a green card holder who held the card for 8 tax years out of the past 15 years. We've talked about those guys before. So either one of them can possibly be covered expatriates if they meet any one of 3 tests. And the 3 tests are as follows. The individual has a net worth of $2 million or more on the expatriation date, or they have an average income tax liability for the past 5 years that for 2025, that amount is $206,000. So we're looking at the past 5 years. How much income tax did they pay each year? We're dividing it by 5. And if that number comes out to be $206,000 or greater, then the person will be a covered expatriate. And the final test is that they have not certified that they have been tax compliant for the 5-year period prior to giving up their U.S. status. So any one of those 3 tests, if you trigger them, you will be a covered expatriate.
And the tax compliance test means meeting all the requirements under the Internal Revenue Code that extend beyond the payment of tax, correct?
Absolutely. It's income tax, gift tax, estate. Well, won't be estate tax, I guess, because you're still alive when you've done the deed.
But there's
excise tax, employment tax, so everything.
Yeah, there's a lot of stuff there. Absolutely. Okay.
Most people think, oh, I filed a tax return, I'm good. Nah, it's not the end of the inquiry.
Okay. So somebody expatriates, they're covered expatriates. So the first problem, although not where we're focusing today, is that the first problem of covered expatriate status is that the actual exit tax rules apply, and it's quite possible, in fact, I would say probable, that you would owe an exit tax, correct?
Yes.
Okay. But that aside, the status of covered expatriate, Virginia, is that a lifetime designation? Like once a covered expat, always a covered expat?
If you go back to the United States and become, a resident again, you might not be a covered expat for purposes of making gifts or bequests during the time you are a U.S. resident. But what they mean by, at least what the regulations have stated, is what they mean by being a resident is that you're a resident for U.S. gift and estate tax purposes, which means you were formerly a covered expat. You've gone back to the U.S. and established your domicile there. Under the gift and estate tax provisions, domicile is the test for whether you are a resident under the gift and estate tax rules. And
basically, Virginia, if you expatriate and you're a covered expatriate, then you have to worry about these covered gift tax rules pretty much for life. Maybe you can find a carve out here or there, but that's the presumption. Yes?
Yes, absolutely. Unless the person, as I say, is going back to the U.S. and creating their domicile there again.
Okay.
I've never known anyone who's expatriated to do that.
All right, that's a carve out. Okay. Now, just staying on this issue of being covered expatriate, let's say that when you were announced, your net worth was $10 million. And so you're a covered expatriate. When we talk about these gifts going back to U.S. citizens and the punitive taxation, does it mean that it only applies to the $10 million you had when you expatriated, or say it's 50 years later and you have $100 million? Would the whole $100 million be caught? Which?
The whole $100 million will be caught, John.
So, Virginia, are you telling me that the United States is claiming the right to impose tax on assets that accrued after the person was no longer a U.S. citizen or green card holder? Is that what you're saying?
Yes, that is exactly what I'm saying, because that's what the law says. I'm not making it up, John.
That I think a lot of people would find that very difficult to believe, but of course you're absolutely right on this. So this is a serious problem it would seem to me for family members, but let's go into what this problem actually is. How does it work? Sort of a 30,000-foot view if we can. So this is found in Internal Revenue Code section 2801, right? So maybe
That's right.
we begin with the bottom line. What does this do? And then let's backtrack and go through it in a little more detail. So what's the bottom line?
Okay. Bottom line is any U.S. citizen or resident who receives gifts or inheritances from this covered expatriate has to pay a special transfer tax, which would be at the highest tax rate imposed on gifts or estates that's in effect at the time they get the gift or inheritance. Currently, that highest rate is 40%. So if you got $1 million inheritance from a covered expatriate, you have to pay $400,000 to the IRS.
Or to use my example of 100 million, the IRS would want 40 million.
That's right.
Now, is that the normal rule for receipt of gifts in the United States? Are gifts taxable? The value of a gift taxable when you receive it?
No, they're not. No, they're not. But,
So you
you know,
tell
this
me
is,
this is some new special rule they made up to punish people who renounce?
well, they can't punish the person who's renounced anymore because they've already punished that person under the exit tax rules and other rules applying to specific assets the covered expat may have held. So once that person is no longer a U.S. subject, then the U.S. has no jurisdiction over him, so they have to let him go. But they can still punish the U.S. family members or good friends or whoever that covered expat will leave a gift or an inheritance to if that person is a U.S. recipient. So they have jurisdiction over the U.S. recipient, and that's why they have to pay the price.
That's pretty amazing stuff. It really is, particularly since it applies to assets that didn't even exist at the time of expatriation. Let me ask you another question on this. I mean, this seems to me to be terribly, terribly punitive. I mean, the way I read this, that 40% tax is more than if the person had never renounced U.S. citizenship, had kept it, and had the $100 million. They wouldn't pay as much. Their estate wouldn't pay as much tax as that, would it? Because they'd be, they'd have certain deductions, and
Of course, and they have the lifetime exemption amount, which is well over $13 million. It's almost $14 million, I believe, for 2025.
So
you don't get any kind of exclusion for that when you are dealing with covered gifts and bequests.
So in other words, what's happening here is that first, the United States is trying to impose tax on assets that were accumulated when the person was no longer a U.S. citizen, number one. And two, the tax that is imposed is actually higher than would have been imposed if the person still had U.S. citizenship and the same assets. Am I getting this right?
Yes, you are.
That is extraordinary. That is absolutely extraordinary. Well, I think it's important that people know about this. Well, maybe we can get into this in a little more detail now. So what's this section 2801 say? Maybe we can unpack it a little more here.
Do you want to look at the code section or just?
Well, I don't think we need to look at the code section with you here. We can just work with your summary or we can.
Yes, I think, as we said, this transfer tax is imposed on any U.S. citizen or resident who receives gifts or inheritances from a covered expatriate. And they have to make the determination whether that gift or bequest is a covered gift or bequest, which means they have to look and understand, was the person who gave it to them a covered expatriate? They've got to be prepared to defend their position that he wasn't, if that's the position they're taking. So that's going to be a little bit difficult.
So, I mean, this is really incredible stuff. I mean, so, normally somebody dies, there's a grieving process, there might be a celebration of life. I mean, it sounds to me like the first thing that people are going to think about when somebody dies is, one, what's their citizenship? Two, were they ever a U.S. citizen? And three, were they a covered expatriate? Isn't that somehow what becomes front and center now?
That is.
I mean, this is absolutely extraordinary stuff. Okay, so maybe the best way to do this is let's just create an example. So we've got, let's say we have a family of U.S. citizens living outside the United States. And this is actually fairly common. I'm sure you would agree. The families lived outside the United States for like forever. They're, probably not returning, but they have U.S. citizen children who may very well go to the United States, for school or whatever, and are likely to remain U.S. citizens. And, it's very common in this world to want to, leave your estate to your children, right?
Mm-hmm.
So now these parents, they were born in the United States. I mean, they certainly weren't born as dual citizens. Let's say they come to visit you, Virginia, and they say, Virginia, I listened to this podcast with that John guy that you did, and I heard all about this thing, and I'm wondering if you can give me some advice here on what can I do to avoid this? I mean, what are some of the questions you'd ask? What would you say to them?
Okay, so we want to know, was the person who gave up their citizenship, were they a covered expat?
Well, sort of prospectively, the family's heard about this. I guess what I'm getting at, would it
Did they have 2 million in net worth?
get rid of their U.S. citizenship before they become covered expatriates?
Well, that would be the ideal scenario. Okay, so if they haven't hit the $2 million net worth and they don't have the income tax liability, and of course, fixing up tax compliance is always possible prior to expatriation. So if they can get out before they reach any threshold to meet covered expat status, that is clearly the best move.
Yeah, I think it is, isn't it? Because I mean that means that you're not a covered expatriate. Therefore, there can be no gifts from covered expatriates. Therefore, this is not.
Exactly.
So I mean, it seems to me that this is a rule. That sort of in recognition of the fact that this estate stuff tends to revolve around transfers to family members, right? This is a rule that actually incentivizes Americans abroad to renounce their citizenship before they hit the $2 million mark to actually protect the family assets. I mean,
That's right.
thinking about this accurately? Would you agree with that?
It is the way people should be thinking now if they are considering, if they're living overseas, if they have another citizenship, if they are happy with that other citizenship, and, many times they are living in the country of their other citizenship, and that is what they consider to be their home. And having the U.S. citizenship may have been through happenstance. It may have been when they lived and worked in America and became citizens and then left America. Many years have gone by and they're settled and happy in their home country, but they're still holding the U.S. nationality. They have to really reconsider whether that's worth holding on to.
Well, particularly given the fact that, this is a clear interference their ability to leave their estate to their U.S. citizen children, right?
Unless that whole family wants to keep U.S. citizenship, once you start having family members that have given up citizenship and they can be covered expats, but there are still U.S. family members, that's when you run into the problems.
Right. So, and this is why I suppose, I've seen a good deal of this, what I call the family renunciation, right?
The whole family goes, yes.
A family that renounces together, bonds together. But this is a very, very, I think serious interference with the, just sort of a normal family and retirement planning. Now, let's imagine another scenario here for a minute, Virginia. Let's say we've got somebody who, former American citizen, covered expatriate, and, and has a substantial estate, and is thinking about, who to leave their estate to, their assets. Would it make sense for that person to ask, well, hey, that nephew of mine, I haven't seen him in 50 years. Would it make sense to ask whether he's an American citizen?
Yes.
Because if he is an American citizen, I mean, really, 40% of what you're giving him goes to the U.S. government, right?
That's right.
Do you think it may get to the point where before leaving bequests or making gifts to people that donors might actually ask for a certificate of loss of nationality from the donee?
Just like the financial institutions, right?
Exactly. I have to know. I have to have proof that you're not a U.S. citizen, so I know I'm really making the gift to you, right?
You know what, John? If they're well advised and really thinking things through, they may just do that.
Well, I think they're going to have to do that. I mean, like, what's going on here? Who can make up these kinds of rules? Have they not thought this through at all in terms of how this might actually work?
Well, I think the bigger problem, John, is that we will have a lot of people that will not be aware of these rules. When the HARD Act came out and I was handling, let's say, any expatriations, I was telling people, you have got to get the past 5 years of tax returns, which have, we have gone through them and made sure everything was compliant and so forth and so on. You have got to get them from the IRS. So you have the IRS stamp on that they were sent to you from the government. And you have got to keep these tax returns and your Form 8854 that was filed with the IRS. You've got to keep these very important documents with your will and let your family members understand this rule about 2801, even though we didn't know what the regulations were saying. We knew the rule was there. And we want the best proof possible that the person was not a covered expat. Now, if you try and get your tax returns from the IRS, good luck. Because if they're old, and I'm talking like 7 years going back, they're going to most likely say, we don't have them. That's been in my experience. So you've got to get them as soon as you can.
Well, I think there's that, but also I can see a future where, where somebody will die and they'll leave their jewelry, their art, their stamp collection, and their tax returns. With the tax returns being, of course, the most important thing, right?
That's the way it's going to be.
This is absolutely, this is unbelievable. I mean, it is comical. You just can't laugh because it's, the repercussions of this are so great. So
Yep.
it's interesting to me, again, right? We see the possible benefits of dual citizenship from birth, right? I mean, we've talked many times about the dual citizenship from birth exemption of the exit tax. I mean, I agree there are some loopholes that you have to meet, okay, to get there. But the fact is that would allow you to avoid covered expatriate status, right?
Yes. At the moment, that's.
Yeah, at the moment, clearly dual citizenship from birth is a value. I mean, as a general principle, if you're doing, family planning and stuff, do you think it's worth having your children born outside the United States in a country with birthright citizenship so they can get dual citizenship from birth?
Wouldn't be bad planning.
Yeah, I think that's right. And what's amazing about this is how just this whole HARD Act, right, without consideration of anything else, has created all these problems. Extraordinary stuff.
Yep. Well, having said that, John, there are various exceptions to this covered expatriate gift or bequest, covered gifts and covered bequests. But I think, they get complicated. The other thing I want to mention that we haven't made clear is that if you are a beneficiary, a U.S. beneficiary of a foreign trust, and that foreign trust has been funded in whole or in part by a covered expatriate, when you get a distribution from the trust, that will be a covered amount, and you have to pay the transfer tax on that distribution.
Yeah, that is absolutely true.
So, people have to worry if they're beneficiaries of a foreign trust, who funded this thing? And, were they a covered expat?
That's right.
You might not know. Think about it, John. Some trusts have been around for a long time. since after 2008, and people die and other younger generations, the trust continues. Okay. And the younger generations are then being given amounts from the trust. How are they supposed to know?
No, absolutely. I mean, this is an absolute trap for the unwary. And the regs, I mean, you made this point, but I want to make it even more strongly. The regulations that came out effective January the 1st make it very, very clear that it's the job of the recipient of the gift to confirm who it came from and whether that person was a covered expatriate, right?
Yes.
So, I mean, they're subject to the specter of all kinds of, penalties, problems, etc. as well. I mean, this is so complicated. It's so penalty laden. It's so dangerous that, I think probably the rule of thumb in life is to avoid any U.S. person. I mean, it's ridiculous. How could a country, make its citizens so toxic, so devalue its own citizenship through just a few tax provisions? It's simply unbelievable, I think, anyway.
I know.
One obvious one is the spousal gift exemption or whatever still intact.
Yes, so long as the spouse is a U.S. person.
Okay. So you can still get, so in other words, if in a family, say one spouse renounces a covered expatriate, the other retains U.S. citizenship, the gifts, whatever bequest, can still go through to the U.S. citizen spouse without regard to this, correct?
Correct.
But now let me ask you part two. What happens if when the U.S. citizen spouse dies, the estate then goes to U.S. citizen children? What happens then? Would that be an indirect transfer?
I don't think it should be. I mean, there is discussion in the regs about indirect transfers, but I would have to really parse through them and see if this might be caught. I don't think it should, but who knows?
Well, I think that's a very, very interesting question, right? Because if it isn't, then that might be a consideration in renunciation as well, right? Maybe one renounces,
one stays,
etc. So, I mean, this is interesting stuff. I hope from this discussion, two things are clear. One, the danger here, and secondly, the complexity. Okay. So I think people need to have a degree of enough awareness to know this is a problem and enough common sense to stay away from the problem by either making sure that you're not a covered expatriate or having nothing to do with any Americans, right?
Well, I tell you, this is going to put a big monkey in the works for people that have expatriated, are expatriating. These are things that there's not terribly much you can do if you've already expatriated, right? I mean, you're going to have to find a way to say, gee, maybe I have to take all my family members with me. They have to give up as well, so we don't have this problem.
Well, that's right. That's right. Or, I've seen instances where, people have flat out said the only way my kids are going to get anything from me is if they renounce.
I've heard people say that too.
40% of my estate to the U.S. government, right?
Yep. Yep.
Very, very interesting stuff. Well, I think we've probably done close to enough damage for today.
Yes, John. Death, doom, and destruction. Our work here is done.
But listen, one other thing I think we might discuss, right? So, basically, the law comes into effect in 2008. The first version of the regs, which basically come out in 2015. I actually remember that we talked about this in 2015. The first version of these things, and now they've been finalized, I guess, and they have an effective date of January 1st, 2025. So clearly,
but hold on, John. What the effective date of January 1, 2025 is dealing with filing the Form 708, which we still don't have from the IRS, as far as I know. And it's the time for filing returns, okay? Because that's in that January 1, 2025 effective date is found in the regulation 6071-1. Okay, so this is not the 2801 section of the regulations. And that is saying that the applicability date is for gifts, applies to covered gifts or covered bequests received on or after January 1, 2025. So that is not saying to me, that is not saying that if you got a gift or bequest since June 17th, 2008, but before January 1, 2025, that is not saying to me that you don't have to pay tax if it's a covered gift or a covered bequest. I believe we are going to hear more from the IRS on that issue.
Yeah, I think you're absolutely right on that. The regulations govern sort of the modus operandi of this from January the 1st. They don't govern.
That's right.
They don't, and I don't think can really, make the tax go away. So that's another level of complexity. Once you figured out it applies to you and all that, I mean, then, how in the world do you actually comply with this stuff? And of course, we don't have the Form 708 yet as well. So this is pretty awful stuff.
I mean, I have to wonder how many people who got a covered gift or a covered bequest, let's say in 2010, are going to worry about filing a form and paying 40% of the tax.
I doubt they're going to worry about it a great deal, but even if they do worry about it, I'm not sure where you get help on this. I mean, this is so extraordinarily nuanced and complicated that, I mean, it's as though they've created, why don't we call it the Section 2801 lawyer or something like that. Terrible, terrible, terrible stuff. Complexity is bad. And this is
complexity is very bad, John. And you and I are both very good tax specialists. We have been reading through these things and we're scratching our head too often on many of the provisions. It shouldn't be that way.
Absolutely not. I wonder if somebody ought to bring a due process challenge, sort of on the basis that all laws have to be understandable to the average person, right? I mean, at the moment, nobody could understand this. It took months to even understand the 877A provisions, right? I mean, in the sense that you could work with them. And these are just small provisions of the Internal Revenue Code. I mean, I guess the difference between a tax professional and a normal person is a tax professional admits they're confused and a normal person just says, well, I don't understand it well enough to be confused. Maybe there's only two kinds of people in America. Those are the two.
Could be.
Anyway.
But I think the takeaway from all of this should be, if you are dealing with, family members, etc., that have given up citizenship or given up a long-term residency, meaning they've held the green card for at least 8 years, you better get as much ammunition as you can on your side to say, look, this person was not a covered expat. They filed all their tax returns. The past 5 years of returns have been acknowledged as received by the IRS. I have transcripts. Whatever you can get the Form 8854. Keep all the copies of these things with the important family documents. Get advice, and understand. The family should understand the basics about these 2801 rules so that when the time comes, when someone passes away who was a former U.S. person, that they at least have a handle on what they should do.
Yeah. Well, we're now in a world, Virginia, it occurs to me, where tax returns are now family heirlooms. You realize
Very important, valuable family heirlooms. You're right.
Exactly. Oh my God.
But unfortunately, that's the truth. That's the sad truth of where we are today. By the way, one of the things in the regulations, just to point this out, the IRS has not yet come up with the procedure. We're still waiting for that. But they said you can request help from the IRS to get tax records about the former American. Now, if the person is still alive, it's a living donor of a gift, and they will need his or her consent to release those records. If the person will not give the IRS that consent, then there will be a rebuttable presumption that the gift is a covered gift. And be prepared, to pay over 40% of your gift to the IRS.
That's right. In other words, unless you can specifically prove did not come from a covered expatriate, you have to pay the 40%.
Yeah.
Why don't we?
It's going to be tough to rebut that presumption.
Yeah. Now, interestingly, I read that with great interest. That particular provision is not in the statute, right? That is not.
No, this is strictly in the regs.
Statute. So, my thought was, my God, is this going too far with the regs? But anyway, as I say, I think we made the general point here. And
yes,
God, what if people really wanted to know more? How would they get a hold of you, Virginia?
Okay, so they can reach me via my U.S. tax blog. I do have something on the regs there that I wrote up a blog covering briefly what the regs are doing. So that's www.us-tax.org. And that particular blog post will be very readily seen when they get to the blog.
All right. Well, great stuff. And I look forward to speaking with you again. Thanks very much, Virginia.
All right, John. You have a great day.